Hey everyone, this is Jim Nelson at Euro Pacific, and this is another market update. Thanks for tuning in today. So, I wanted to take a moment and talk about everything that's been happening recently because there's certainly been a lot going on, and we've seen a lot of volatility in the marketplace. Now, earlier this year, we talked quite a bit about the risks we were watching, especially with respect to inflation. And inflation is still a problem. The latest numbers show inflation is stuck right around 3%. It's still higher than the Fed's goal of 2%. Core inflation is also higher than the Fed's goal at 3.3%. That excludes food and energy prices. So clearly, the Fed still has its work cut out for it. And this puts the Fed in a tricky spot, right? How do they handle inflation without choking off growth? It's definitely not an easy task. And about the growth, things are slowing down a bit already. We saw GDP growth slip to 2.3% at the end of last year, compared to over 3% just a quarter before. And if you've looked at the recent PMI data, you'll see that manufacturing, unfortunately, has dipped below the critical 50 level, which means it's contracting. Even the services sector is showing signs of slowing down. What's driving all this caution? Well, in our opinion, a big part of it is the uncertainty around tariffs and just general policy uncertainty in general from this new administration. Businesses are thinking twice before making new investments, and that's impacting growth. And we published a piece a few months back where we discussed tariffs and the fact that they could boost the US dollar. But we've now changed our viewpoint on that given what we've seen with respect to US growth. With US growth cooling off, suddenly the dollar doesn't look quite as exceptional, and that's because interest rate differential expectations are narrowing. Plus, Europe's boosting defense spending due to geopolitical tensions. This is good news for European growth and profits, and the markets are already looking to price that in. But it might narrow interest rate differentials even further, pushing the euro up against the dollar. So the dollar strength story isn't necessarily in place any longer, and that's something that we're going to be watching closely. Here's something else to think about. What if the US keeps moving away from its traditional allies? With all these trade threats and talk about possibly pulling back from alliances like NATO, could we possibly see a shift in how the world views the dollar as a go to reserve currency? It's definitely something worth thinking about and something worth watching. Now, on the fiscal side, those huge deficits aren't going away anytime soon. Last year's deficit hit around 1.8 trillion, roughly 6.7% of GDP. It's big. While long term, that's something to be cautious about, right now, this fiscal stimulus is still pumping money into the economy, which could help support growth later this year. And let's not forget the consumer. Thankfully, the average American household still looks pretty resilient, thanks to fixed rate mortgages locked in at historically low rates and pretty decent cash reserves left over from the pandemic. This financial cushion is definitely helpful, especially when volatility kicks up. So, where does this all leave us? Yes, things are complicated, but it's important to stay cautiously optimistic. While we may see continued downside in markets and continued volatility, there's reasons to remain fairly optimistic over the long run. At Euro Pacific Asset Management, we're sticking with what works: diversification, high quality companies, and investments that can stand up to inflation. If you're interested in how we can help you and your portfolio, please reach out to one of our advisors or visit europac.com. Thanks for joining us today, and we'll see you next time.